The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Show with Mandy Jury, and these are your headlines. The US aims to finalise a flurry of deals ahead of its tariff deadline, while EU talks extend into the weekend. But Commission President Ursula von der Leyen expects only a framework agreement in the short term.
We consulted on a rebalancing list, and we will defend the European interest as needed. In other words, all the instruments are on the table.
After several all-nighters, Republicans finally forced through President Trump's sweeping budget bill in time for the US leader to sign it into law today, the 4th of July.
1 year of Keir Starmer and the Labour Party marked 12 months in power to cap off a week marked by a tearful Chancellor Rachel Reeves on the front bench, while the PM scrambles to reassure a jittery bond market.
Well, first up, welcome, Mandy, and happy Friday. Nice to have you on.
Friday to you as well. You know, you were joking just a moment ago that it feels like Squawk Box Australia all over again, which is really a blast from the past. But
well, you and I have done every type of Squawk Box possible together, I think.
We really have. I don't know how many there are around the world, but I'm going to say at least 4 or 5 Squawk Boxes somewhere in the world.
Most major jurisdictions. But I've got to say, big day. We're really rattling through the agenda, aren't they? We've got BBB. We're talking about trade deals. We're counting down to the 9th of July, and all these letters are flurry of letters about to be sent out to everyone. Europe's hoping that there's going to be some sort of agreement, some sort of framework at least they can work off. And of course, we had the data out yesterday and the non-farm payrolls report coming a little bit early with 4th of July, suggesting that, look, maybe Jay Powell just got some extra ammunition to sit on the sidelines and wait it out for those tariff impacts.
And I think what's really incredible is the way that the US market was really able to shrug off the fact that we're seeing a paring back of those bets for rate cuts after those strong non-farm payrolls, because normally you would expect a result like that to be a negative for the US stock market in the sense of, oh dear, we were hoping for that rate cut in July, we're probably not going to get it after all. But obviously they're really latching onto the good news side of we have a resilient and stronger economy than perhaps we originally thought.
Yeah, nothing's touching the sides. I mean, tech stocks have been very strong, and that's the area you think would be a little bit interest rate sensitive. But interesting to see the banks really taking off yesterday.
Yes.
So that really was the trade. Now let's get into the latest around Europe, because the EU is closing in on a framework trade deal with the United States, according to EU Commission President Ursula von der Leyen, who said that a full agreement would be impossible to reach before next week's July 9 deadline. Speaking on Thursday, von der Leyen underlined the complexity of the task facing trade negotiators.
It's a huge task because we have the largest trade volume globally between the European Union and the United States, 1.5 trillion euros, very complex and a huge quantity. Indeed, what we are aiming at is an agreement in principle. Because, I mean, such a volume in 90 days, an agreement in detail, impossible.
Speaking to CNBC, US Treasury Secretary Scott Bessent was hesitant to say whether a trade deal with the EU would be reached before the deadline.
Everyone waits till the last minute. They think that they can get the best deal. And as I've warned when I've done other media, these countries should be careful because their rate could boomerang back to their April 2nd rate.
On that note, Mr. Secretary, the EU Commission Chief Ursula von der Leyen tweeted earlier saying that we're ready for a deal. Should we expect the EU deal to get over the line by Wednesday?
We'll see. Again, I'm not going to get out in front of the president. It'll be his decision. I did meet with my EU trade counterpart this morning. Ambassador Greer will be working diligently over the weekend. So we'll see what we can do with the European Union.
Meantime, President Trump says the US will begin sending letters to countries setting out their tariff rates on exports to the United States, with 10 to 12 nations set to receive theirs today and begin paying those tariffs on the 1st of August. The Treasury Secretary, who we just heard from a moment ago, Scott Bessent, told Bloomberg that he expects to see around 100 countries face a 10% levy, the baseline of the so-called reciprocal tariffs. Well, speaking to reporters before boarding Air Force One, Trump said that his preference is for a simple approach.
So we have a couple of other deals, but my inclination is to send a letter out and saying what tariff they're going to be paying. It's just much easier. We have far more than 170 countries. And how many deals can you make? And you can make good deals, but they're very much more complicated. I'd rather, and I've been like this from the beginning, I'd rather send out a letter saying this is what you're going to pay to do business in the United States.
The US House of Representatives has passed President Donald Trump's sweeping tax cut and domestic agenda bill in a vote which largely fell along party lines. The legislation's passage came after a series of delays from Republican holdouts, as well as Democratic Minority Leader Hakeem Jeffries, who delivered a record-breaking floor speech lasting almost 9 hours, slamming the bill. US non-farm payrolls rose a greater than expected 147,000 in June, driven by a 73,000 increase in government employment, boosted by state and local hiring. Traders sharply reduced bets on July Fed rate cut, now seeing an around 5% chance of a cut compared to more than 20% before the data. We'll get into the weeds on this shortly, but just a quick look at that market reaction. Stateside yesterday, we saw the Dow, the S&P, NASDAQ all bouncing again, fresh records for the S&P 500 and the NASDAQ 1% up for that tech-heavy index. The Dow just a whisker off its all-time high as well, so within touching distance. Let's get to Abby Watt, US economist, UBS. Abby, so nice to have you this morning to pick through this data. Clearly coming a day earlier with the 4th of July holiday in the mix. But if you look at the headline numbers, it looked like it was a very tame number, a bit Goldilocks in a sense that you still got an employment market intact. But if you dug a little bit deeper, you could see that there were just a little bit of a weakening taking place. Average earnings at 3.7%, but manufacturing jobs fell by 7,000. And without that participation rate, you actually would have seen the unemployment rate rise to 4.7%. So what did you make of the data?
Yeah, look, I think as always, with all of the employment data and any report we get in the US, we really have to dig into the detail and kind of look at under the hood a little bit more. I think June in particular is one of those months where you tend to see very strong hiring, as you mentioned, in kind of state and local, and it's particularly in state and local education. You see kind of big inflows and outflows in the sector, and you tend to see a little bit of a bump in June in those numbers. But one of the things I would say is that we tend to see strong revisions to that. So for example, last year you saw a 70k gain in government in June 2024. That's now 21k in the current vintage of that data. So even though we saw kind of a strong contribution yesterday from government, we could potentially see that revising down. And then when you look at private sector hiring, that was relatively muted in the print. Yeah. And one of the things that we would look at as well is the diffusion index. So this looks at the subsectors of private sector employment, and that's slipped below 50. And that indicates that you're seeing kind of more subsectors with job losses than you are with job gains. Yeah. So I think under the hood, maybe the report looked a little bit less rosy. So
if we pull it together, and the point I was making about the numbers yesterday not really being anything to spook the Fed into another early cut here, it's quite different having a handle of unemployment closer to 4% versus a handle closer to 5%. And if there were mitigating factors here around participation rate, what does it mean for the Fed's dual mandate? Should there be concerns about full employment?
So I think for the Fed, they'll be looking at the totality of the report. They'll be looking at both what's happening in the kind of non-farm payroll establishment survey. They'll also be looking at the household survey, which is where the unemployment rate comes from and where your participation rate comes from. And I think, they'll be aware of kind of potentially some of the factors that could be kind of depressing the print in any month or contributing to a print in any month. I think for them, it's the overall trend in the labour market. And when you look at kind of a range of indicators, not just those two surveys, if you look at kind of initial claims and continuing claims, you've seen those also kind of pushing higher, and also pushing higher than we would typically see at this point in the year. We would be expecting them to move higher through this point, but they're seasonally moving a little bit higher and a little bit faster than we would have expected at this point in the year. So I think for the Fed, I think they'll be looking closely at the labour market data. I think you've obviously heard a couple of members of the committee, Vice Chair for Supervision Bowman, you've heard Governor Waller kind of referencing this idea that even potentially putting a July cut on the table, given the kind of employment data. And I do think it's an important part of their mandate and something that they'll be looking at. But I think, the overall message from the committee has definitely been one of, we need to wait, to be patient at this juncture, because they are expecting to see that kind of tariff-related inflation coming through in the summer.
So what are you expecting with regards to the Fed for the rest of the year, considering that, there have been some quite aggressive pricing for rate cuts, which gradually, bit by bit, have been pared back?
Yeah, so it's interesting, actually. We've been a little bit kind of above consensus on the extent of cuts that we'll expect from the Fed this year. And for kind of most of the year, we've been expecting 100 basis points of cuts from the Fed this year. Now, in terms of the timing of that, we had thought that it would be backloaded. So we were expecting that would come from the September meeting onwards, and we continue to expect that. So we're expecting the next cut from the Fed at that September meeting. And I think that's very much predicated on this sense that we think that the labour market will actually slow more materially as we go through the summer. So even if you start to see some of the kind of inflation pressures coming through from tariffs, we do think that there will be kind of a significant enough loosening in the labour market for the Fed to kind of want to remove the excess restrictiveness that they currently have in the policy rate.
So I'll ask you a sort of a 2-for-1 deal question here. And number one, are you surprised by the resilience so far of the labour market, despite the fact that, of course, we've had all the uncertainty surrounding tariffs? We've also had AI starting to eat away gradually as employment. And then the second part of that question is, if you do expect the labour market to start softening up, what do you think is the key driver of that?
Yeah, so I think one of the key drivers of that is just just overall. One part of it is a slowing underlying, right? We've seen a slowing in US growth, and you would expect that the labour market should be slowing alongside that slowing in growth. So I think that's one element. I think the other element is potentially some uncertainty, some policy uncertainty, and businesses. Obviously we're expecting that there'll be some kind of cost push. Inflation for businesses, and one of the ways in which they can reduce their costs is by reducing their wage bill. So I think you should see kind of a lower demand for labour as you start to see some of those tariff effects kind of coming in. I think those are the two things that we would expect to kind of see factoring into kind of weaker hiring as we go through the summer.
Let's just put a few of the big pieces together, because overnight we also heard from Raphael Bostic, someone who's in studio earlier this week, and he's talking about it being 1 year that it could take to digest the trade tariff implications. And we know that the tariff negotiations sort of went into the slow lane. They're taking much longer than we thought to try and achieve some sort of change. At the same time, the BBB seems to have taken a super speed in the fast lane, and that's got some traction. So how do these dual policies from the Trump administration come together and impact the economy from here?
Yeah, look, I think it's an important thing to raise, because the interaction of the two is going to be important in terms of the contour of growth and the contour of inflation, probably. So if we think about the kind of one big beautiful bill, a number of the kind of elements of that, you won't necessarily see that impacting activity and growth until, say, the end of 2025 into the first half of 2026. Whereas the tariff policies, we've really seen a ramping up in tariff policies over a number of months now. We've seen the tariff rate hitting around 15%. That's a 13 percentage point increase versus last year. And I think that that's been in place for a while. So you should start to see the tariff-related hit sooner, I think, than you see some of the offset potentially from fiscal policy. So I think you could see a weakening before you then see an improvement in the following year.
One of the most standout features of the first half of the year is, of course, the weakening of the US dollar, which has, of course, had everyone piling on the bandwagon and talking about the demise of the dollar as a reserve currency. Where do you see it standing in the global economic world order? And do you think that the second half of the year is going to see further weakness in the dollar, or do you think a lot of the bad news, a lot of the downside drivers are already factored in?
I think it will really depend on the state of the economy, right? So I think our expectation is that you see kind of a more significant slowing in the economy from here, and you see 100 basis points of easing from the Federal Reserve. I think alongside that, you would naturally expect to see a little bit of a weakening in the dollar. So I think you've got that kind of pull down effect from the policy angle. I think the other kind of upside potentially is whether you see kind of a more positive sentiment just generally towards US assets. If you see some of the uncertainty around trade policy kind of fading, I think that's the other potential kind of upside here. But those are the kind of risk factors that we'd be watching.
The attacks on Jay Powell have kept on coming from the Fed. And despite referencing two Fed members who are providing a little bit more lenient commentary about rate cuts, it feels as though Jay Powell is just weathering the storm. Does that have any bearing, do you think, on the credibility of the central bank holding the line at a time when we think inflation is going to be still forthcoming?
Look, I think they're very aware of what their role is, what their remit is, and I think Chair Powell is obviously very cautious and careful not to kind of overstep or go beyond kind of the monetary policy remit that they have and that they've been set. Obviously, his term is ending next May, so there's clearly, you know, an opportunity for the administration to make changes within the kind of leadership of the FOMC. And you know, I think Chair Powell will kind of just continue to kind of have that kind of messaging of, we know what we're here to do and we're going to get that job done. And I think that's what he'll continue to do for the foreseeable period.
Abby, thank you so much for joining us. Abby Watt with us, US economist at UBS. A quick look at some data that's been hitting the tape this morning. Just out moments ago was the German industrial orders. They were down 1.4% in May. So we are still seeing some weak numbers cropping up thanks to the trade situation. That was also the case across in Asia earlier in the week. So the core economy in Germany seeing that slump in the orders. Pushing on, coming up on the show, it's been 1 year of Keir. Prime Minister Starmer and the Labour Party marked 12 months in power amid a week that saw a dramatic welfare climb down, a tearful Chancellor and markets questioning their faith in the government. Plus, Air France KLM announces plans to take a majority stake in SAS, saying the deal reflects the successful post-COVID turnaround in its Scandinavian peer. And we'll be crossing live to the south of France. Charlotte is at a very tough economic forum in Aix-en-Provence. She'll be speaking to a flurry of special guests, including the CEO of Veolia, that is coming up at 8:30 London time. You all know the saying, a week is a long time in politics, but this one has stood out in particular. For a moment of the week, we're looking at British politics and the custodian of the world's sixth largest economy reduced to tears on the benches of the House of Commons. Speaking at an event on Thursday, UK Chancellor Rachel Reeves says it was because of a personal private matter.
Clearly, I was upset yesterday and everyone could see that. It was a personal issue, and I'm not going to go into the details of that. But my job as Chancellor at 12 o'clock on a Wednesday is to be at PMQs next to the Prime Minister, supporting the government, and that's what I try to do. I guess the thing that maybe is a bit different between my job and you know, many of your viewers is that when I'm having a tough day, it's on the telly, and most people don't have to deal with that.
So the clarification that nothing is public as sovereign debt or the nation's finances. Her comments came after an outsized market reaction saw the 10-year gilt yield spike by more than 20 points as Keir Starmer, the Prime Minister, equivocated on whether Reeves would keep her job. At one point, set to record the sharpest sell-off since October 2022, the days of Liz Truss. Sterling also under pressure after a vote on a bill that was meant to save the government's £5 billion that ended up saving basically nothing at all, or according to one estimate, costing it £200 million. So let's piece this all together. Reeves has come under intense criticism since the Labour government came to power from all sides of the political spectrum. But this week may have given her the most security in months. It all depends on whether Wednesday's market upset was down to investors' fear of her departure or simply concern over the state of public finances. A look at how gilts are now faring in the Friday session. This is the trade this morning as we take a look at the UK bond market and just what is now being priced in on sovereign debt. And of course, the long end of the curve is quite key at this stage, the 10 and the 30. And what we're seeing on the 10-year, 4.54% this morning. So a little bit calmer than earlier this week. All this as today marks 1 year since the election that brought Labour back into power for the first time in 14 years. Ritika Gupta filed this report.
We said we would end the chaos. And we will. We said we would turn the page, and we have. Today we start the next chapter.
It's been 1 year since Labour's return to power here at Westminster. And after a landslide victory, it appeared that the party had turned over a new leaf after 14 years in opposition. But it's been nothing short of tumultuous for Prime Minister Sir Keir Starmer. Big promises, especially on the economy, have failed to materialise. And as a result, Starmer's popularity has plummeted in the polls. Chancellor of the Exchequer Rachel Reeves vowed to fix public finances, but her pledge to rule out both tax rises on working people and any increase in borrowing left her in a difficult position. Ultimately, the reality has been a series of U-turns on welfare and spending cuts in her spring statement, and even speculation about whether she will be in the job by year-end. With little room to manoeuvre, senior economist at the Resolution Foundation, Simon Pittaway, now sees a rising prospect of fresh tax hikes in this autumn's budget.
As far as we're concerned, sticking to the existing fiscal rules is really crucial. That's a move that would signal kind of credibility and confidence to the market. Depending on the government's priorities, some combination of higher taxes and lower spending out towards the end of the forecast period might be the way forward.
Domestic issues aside, where Labour has arguably had more success is on the international stage. The government delivered a triple whammy of trade deals with India, the US and the EU. While many political commentators have hailed these developments as major breakthroughs, the overall economic impact remains to be seen.
I think the reset of relations with the European Union is important, long way to go with that, but that sets us back on a sensible track. And I think he has managed this incredibly difficult task of working with President Trump really quite adroitly. We have the trade deal, and it's been trumpeted as a historic trade deal. I wouldn't call it that. It's essentially limiting the damage that Trump would have done otherwise to our trade.
But it hasn't been enough to get Labour's ratings back on track. Keir Starmer's popularity with the public fell to a record low in May, according to a YouGov survey. At the same time, rival Reform UK is gaining popularity. Recent polling shows that Nigel Farage's party is on the way to get the most seats if an election took place this year.
What the rise of Reform, I think, illustrates is the level of disaffection with politics and political outcomes. This should be redressable by good policy making, good, honest policy making, but it will take time.
As bad as the outlook may be for Labour, with another 4 years until another general election, Starmer may still have some time to turn the ship around. Ritika Gupta, CNBC International, Westminster.
And I'm pleased to say our UK reporter, Ritika, joins us now. Thank you. And your first one on Squawk Box Europe, so welcome. Nice to see you.
Thank you. Yeah, it's exciting to be here.
Yeah. Let's get into the weeds on this because it's been such an incredible week. We're already counting down to the 1 year mark, and then bond markets take off and so does pound. What I saw this morning in analysis was that it's good to have some reflection here that it is one thing to be an opposition party and it's one thing to be a good governing party. How do you think about what Keir Starmer and Labour has been up to in the last 12 months?
Well, you know, Labour clearly has had a very difficult year. And it's surprising in some ways because they came in with such a landslide victory and they were in opposition for 14 years. So this was supposed to be their big comeback, you know, their big chance to shine. But really what we have seen is they just haven't really been able to get the economy on track. And that was what people cared about. The government's main mission that they pledged out is to be returning economic growth, making people feel better off. But instead, what we've seen is business optimism slowing, job creation muted, labour productivity low. In April, we had the economy shrinking by the most since 2023. And, you know, we've just seen the havoc that we've had earlier this week. So that's just added more fuel to the fire.
Absolutely. What do you think the markets are wanting? Because always what the markets want and what the markets get are two completely different things. So from an economic policy perspective right now, what are they hoping for?
So the market right now wants some credibility from the government for what we've had earlier this week. They want the fiscal rules at this point to remain in place. They want Rachel Reeves right now to remain in place because the concern for the market is that if they get if she's sacked and they get somebody else in the job, maybe they'll be more leftist and they'll want to, you know, they won't care about spending a lot more. And the risk there is higher borrowing costs. And they really want to avoid what happened back in 2022 in the mini budget because borrowing costs just soared then.
I've seen various different governments over time, and one example was Emmanuel Macron came to power, very big pledges, huge momentum behind him in France, and other events got in the way, as well as some domestic pressures, namely the Gilets jaunes. Rachel Reeves' line was like, the world has changed. The world has changed around us. And there is an element of that. We can all see the geopolitics. We can all see the trade tensions. But some of what has happened over the 12 months has been their fault as well, right? I mean, we saw the welfare changes this week, the flip-flop on that. And we've also seen the pressure that's come to bear on businesses and the higher costs that business has to weather now at a time of very difficult international challenges. So how much is the government's responsibility?
So on the one hand, you can understand that Labour have inherited this economy to an extent. So, Rachel Reeves said, for her tax hikes in October, they needed to wipe the slate clean because the debt to GDP ratio in the UK is just so high. So she's trying to bring that down. But on the other hand, yes, with her fiscal policy rules, that seems to be what's perceived as one of the biggest sort of mistakes or blunders that they've made, because she's given herself such tight fiscal rules. She doesn't want to increase taxes for working people, but at the same time she doesn't want to borrow money. And so what ultimately has been the reality is a series of U-turns on welfare spending, cuts to the spring statement, and now even questions about whether she's going to stay in her job. And so come autumn budget, with such little room for manoeuvre, the expectation is that we're either going to get tax hikes or spending cuts or a combination of both. But clearly what we've seen is that spending cuts are not easy for the government to get through. So it's likely it's going to be tax hikes.
I don't want to be too brutal about this, but I thought until this week we were talking about a two-term government. But after this week, are we down to one term?
I mean, that remains, of course, to be seen. I think what we've seen, though, for Labour and Keir Starmer, his popularity rankings have really plummeted. In May, a YouGov study showed that it was the lowest on record. They have since improved since then, but at the same time we're seeing the rise of Reform UK, and so that is concerning for Labour. They really need to tackle some of these challenges on the economy.